Hello, welcome to the weekly technical analysis review here at XM.com. I'm Rafi Boyajan, currency analyst, and today's Monday, December 11th, 2017. Today we're going to be looking at the dollar yen, the euro dollar, the pound dollar, and gold. So let's start with the dollar yen on the daily chart. We can see there is strong upside momentum with the stochastics heading into already the percentage K line is already in oversold. Overbought territory, though there's no sign yet of a bearish crossover. We can see prices hit a four-week high of 113.68 earlier today. If we do see further gains, we're likely to see resistance coming from just under the 114 handle, around 113.90, and that's the 78.6% Fibonacci retracement of the downleg from 114.73 to 110.83. A break above that level could see prices targeting the 8 months high of 114.73 from back in November, and we know that there is a very strong resistance area around 114.50. We can see previous attempts to make a sustained climb above that level have failed. So without a break above that level, we're unlikely to see dollar yen breaking out of its longer term range that it's been trading in for more than a year now. If we see the current the immediate momentum shifting downwards, which is possible given that technical indicators are now showing that they're in overbought territory, because we should likely see support coming from around 112.80. That's also where the 50-day moving average has flatlined at the moment. A drop below that level, we could see prices hitting the previous support area around 111.65. We can see that's also where the 200-day moving average currently is, and just above that area around 111.75 is also the 23.6% Fibonacci retracement. A drop below that support area could see prices targeting the 2.5 months low 110.83 from late November, but still even a break below that, dollar yen would still be trading within its recent range. Moving now on to euro dollar, we can see that it is looking very much neutral at the moment for the pair. Prices found resistance at the 1.18 handle earlier today. That's the 38.2% Fibonacci retracement of the up leg from 1.1553 to 1.1960. We would need to see the pair challenging that high 1.1960 from November in order to regain enough upside momentum so that then it could challenge the 2.5-year high 1.2092 we saw back in September, and then that would signal the resumption of the longer-term uptrend. In the medium term, though, it is looking rather neutral. We can see RSI is flat around 50, and if we see prices breaking below the 50% Fibonacci at around 1.1755, then we could see that key support area around 1.1660 coming back into focus again, and then a drop below that, we could see the next key support coming from 1.1553. That's the 3 months low we saw back in November. A drop below that would potentially risk shifting that neutral outlook to more bearish one, as it would take it closer to the 200-day moving average. Moving now on to pound dollar, we can see the pound dollar is also fairly neutral. RSI is flat just above 50. Pound dollar did manage to break above its recent range, climbing above 1.3340, which had previously been the top of that range between October and November. However, it did find strong resistance around the 78.6% Fibonacci retracement over the down leg from 1.3656 to 1.3026. It peaked at 1.3549, which was a 10-week high. So there is a strong resistance around 1.3520. Without a break above that level, the pound dollar is unlikely to be able to top that 15 months high 1.3656 we saw back in September. So it's still, in a way, it's still stuck in a range. It's just one leg higher than its previous range. We are seeing strong support coming from 1.3340. A drop below that level would risk the near-term bias to the downside. However, as long as it remains above 1.30 and below 1.3650, then the neutral medium-term outlook will remain intact. And we can see, though, although we did see strengthening of the upside momentum in the medium term, we can see the MACD rising above its red signal line, turning strongly in positive territory. It has now slipped just below its red signal line, so it's once again looking like it's unlikely to find enough momentum to break above it, the top of the range. So it's looks like it's going to be stuck in a neutral mode for a while longer. And finally, looking at gold, things aren't looking so good for gold at the moment. It is looking oversold with stochastics below 20, though there does appear to be a bullish crossover, or an attempt of a bullish crossover, with the percentage K line trying to rise above the percentage D line. That's why we are seeing some pickup in prices today, having hit a 4-month low, $1,243 an ounce last week. It is prices at the moment are below both the 50 and 200-day moving averages. Further downside could see the next support coming from the 78.6% Fibonacci at around 1,237. That's the Fibonacci retracement of the up leg from 1,204 to 1,357. If it's unable to hold above that level, we could see gold targeting the 1,200 handle, and a drop below that all-important psychological level could potentially shift the medium-term outlook to a bearish one. We can see we were seeing a bit of an uptrend at the start of the year up until August, when it hit a one-year high, 1,357. It has been consolidating since, but it is now risking of moving out of that range if it drops below 1,204. On the upside, we have very strong resistance at just below the 1,300 level. If it's unable to break above that level, we're unlikely to see the gold prices shaking off that bearish sentiment, or the neutral to bearish sentiment we're seeing at the moment. That's it from me. Thank you very much for watching, and have a great day.